How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is Forex Fridays. I hope you and your loved ones are safe. I'm actually doing this recording for the second time because the first time I did it that Friday night during the Zoom session, I wasn't actually recording the audio. I just got a new laptop, so I'm still getting used to the programs on it. However, we're going to do it all over again from scratch because I love you guys, and we're going to talk about the Asian session model tonight, December seasonality. We're going to talk about the track record for gold. We're going to talk about how gold has been outpacing fiat currencies, especially the US dollar. We're going to talk about counter trend candles. We're going to talk about pair correlations, and we're going to answer a few questions I had in the chat during that day. So to begin with, this is the spreadsheet that I've shared with you guys in the channel or during the YouTube links or anything in the description. If you don't have it, just go back to the Asian session library. You should see a link to this document and you'll see the results. So the way I have it set up for November 2023, I have it date, day, entry, stop loss, 10 pips, 20 pips, 30 pips, 40 pips, and then a plus sign. Now the plus sign is 10 pips. So if you see any plus sign, that's just an additional 10 pips. And we'll go through it together. I should have explained that. I wrote it down on the actual spreadsheet itself. But since you're hearing it verbally from me, you know exactly what it is. Now, anytime you see an F on here, it's just a fail of a 15 pip SL. So the trade went against you and it didn't fail 40 pips. It only hit 15 pips as an SL. That's why I have it on the right hand side here as a stop loss hitting only 15 pips. And you'll notice that this month wasn't super successful in the amount of pips, but generally it did produce a positive result. We got 150 pips. So I went through every single day during November and I calculated whether or not if it gave us a successful trading opportunity. But if you go back to October, we saw the results. October was much better. We had 350 pips. However, for November, it was a little different. So things may definitely fluctuate month to month, but overall, as I'm still backtesting and gaining the data from this model, we can see it is feasible and it's just something simplistic for every level of trader. So we're going to go in and look at most of the successful days because we had a lot of failed days and mainly a lot of no entry days. So where you see NA, no answer, I should have put NE for no entry. There was no entry at all. So either Asian session went about and it didn't create the market shift, or it did create the market shift and it never went back down into the market shift. So for some reason that day, no entry. But we're going to look at all the days where we did have an entry. So the first day that we had an entry and that was successful, we're not going to talk about the failed days, but we can see here on the 9th. So we're going to go back to the chart and we're going to go back to the 9th of November. And all these examples I have on YouTube is mainly based with UJ. Still getting used to this computer's touchscreen too. I prefer my Mac, but hey, we're gonna get used to it. And you can see the time period that we're looking at is from 12. Let me get this out the way. So it's 12 p.m. right here to 8 p.m. So I know many of you guys are already familiar with it, but if you're new, please just follow along. It's very simple. I'm gonna show you the same model for the next couple examples here. So 12 to 8 p.m., you're normally going to face consolidation. And I'm going to put on a session indicator to describe that. So any of these gray zones are lunch periods or dead zones where you shouldn't be trading. So there's no reason why you should be trading inside of any of these sessions. So you have the New York lunch period, you have the Asian lunch, you have the London lunch. And those are periods where the market is most likely going to move sideways. Not to say there are not moments in times where the market does trend, because that is true. The market can trend in those time periods. However, I've seen often the market tend to accumulate and stall sideways. It's very apparent once you put the session indicator and you start to study during certain times, the market just starts to coil up and start to build in buy side and sell side sentiment. So order sentiment is being built up in all these gray zones. You should try your best and you should definitely exclude it from trading in your trading program or model. However, what we're going to utilize is the swing highs and swing lows that do form inside of this session to help us trade the next live session. So that would be the Asian session. So you see here highlighted in green, that's the Asian session. So that's what we're primarily looking to find our trade within that window. Now that window is going to be from 8 p.m. to 12 a.m. And how we find the liquidity pools to help us trade the Asian session is through the swing highs and swing lows that are unbroken. And if it's not a swing high or swing low, it's either the lowest low or the highest low. So here we have a swing low, so we're going to mark it off. And by definition, what makes this a swing low? Well, it's a swing low, if you zoom in here, because the candle here on the left of it has a higher low, and the candle on the right of it has a higher low as well. So this candle right here is the swing point right there. And we're going to find a swing high, which is inverse. A swing high has a lower high on the left and a lower high on the right. It only takes 3 bars for you to find this pattern. And we're actually going to use a replay function so we can see it together. I'm going to make it red. I like to be organized. Keep my highs marked off with red and my lows marked off with blue. I think we have another one up here. So you can see these are relatively equal highs as well. Even though the highs are not exactly the same pip price point, they are all relatively equal to each other. So we can tell that it's most likely going to be buy stop orders residing above here, right? Retail traders probably looking to buy long on a breakout, or retail traders that were short and have a stop loss above these equal highs. So this could be an area for target. We have this swing low here right before 8 p.m. And we have one more here as well. Now, normally I'm much faster with this because I'm not using a mouse here. And we have the opening price here, which is very significant to the price. It's actually better for me to take my time. Sometimes I could be speaking, 1,000 words a minute and moving really fast. So this is the opening price for Asia session, 8 p.m. So we're just going to mark it off as Asian open. And now what the model is essentially looking for is a purge on liquidity and a revert. So we're looking to see if the market is going to break buy side, purge buy side, and then revert back down to sell side, or vice versa. It's going to purge sell side and revert back to buy side. So it would look something like this if I drew it. So purge sell side, then revert back up to buy side for a trade opportunity. And same thing vice versa. Purge buy side, going back down to sell side for an opportunity. So that's what we're simply looking for. It's a turtle soup, a false breakout pattern that we're trying to catch. We're trying to find people to match our counterparty. We're going opposite to their trade. While they're buying, we're selling. While they're selling, we're buying. So let's play it forward and see what happens. As you can see, price comes down and purges the sell side liquidity. Now at this point, there's a possible opportunity for us to find a long setup. And the normal time frame that I like to find a setup on is the 1 minute. Now you can find it on the 5, 3, or 2, or even seconds, but I prefer just the 1 minute. That's just the way Deontay likes to do things. At this point, we can see now we're below the Asian session low, and we want to bring it back a little bit here right when we break it. At this point, when price breaks that low, I should be hunting for a setup to go long. So retail traders are most likely going short, and they're shorting where? Below the opening price, which is not ideal. As a retail trader, you want to be selling in a premium, which you can see the algorithm was consolidating and even holding itself here in a premium, and then it sold off. That would be the ideal sell scenario. Not to say you would see one there, but you can see how the algorithm is programming itself to sell at the highest price possible. Same thing vice versa. You want to be buying in a discount. Buying cheaper makes sense to you as a businessman or a businesswoman. You don't ever want to buy at a higher price. You want to buy at a cheaper price and then sell at a higher price. That's just how it goes. You buy a certain good and service, you reprice it, repackage it to the customers, and you sell it for the high. That's how it works. As price comes down here, I'm going to be alert and attentive, because that opportunity for me to find a buy may not last long, because discounted prices don't last long in a buy environment or uptrend environment. It's there and then it's gone. The same thing said vice versa. So as we play price forward, We're looking for a market shift, and the market shift is going to come by way of a swing high broken by a fair value gap, and that's what happens here. That's our small fingerprint here that we all know if you studied ICT's material. That there is the fair value gap that we're waiting for. That's where we're going to look to find our entry to go long. This is the fingerprint insisting that the market is potentially getting ready to leave this area and go higher. So what do? We take a long position here, wait for price to come back down into that fair value gap. And what I'm doing is I'm going with a 15 pip SL and a 15 pip TP. That's a general basis to the model. It's very, very straightforward. I'm not changing anything too much. If it's not 15, it's going to be 20. And I'm aiming for a 1-to-1. So you can see here, this is a 15 pip stop loss. And if we go back up to the top, we got a 15 pip TP. I just can't get it on 15. This touchscreen is funny. It's pretty close. So it's a 1-to-1 setup. So that's what I have marked off here in the Excel spreadsheet. So you can see here, that's the entry, that's the stop loss. Where is it at? Is this one, the first successful one. So that's at Thursday on the 9th. So this is the entry, stop loss, and then we have the amount of profit here. So we can see got us 60 pips, and we're going to see that together here. So when we play it forward, we can also see that our reward is definitely within the means of reach of 15 pips by those 15-minute swing highs here. So you can see that it's transcribed here on the 1 minute. Those are those 15-minute equal highs on the left here on the chart. All of this here. So we're going to be aiming and most likely suspecting price to go back to fair value, which is the opening price. The opening price is fair value because it's not premium or discount. So it has to be fair value. You're not buying cheap or you're not selling in a premium. It's just fair value. It's the opening bid or the opening price for the session. And as we play price forward, we're going to see how price trades. Now, if you're an experienced trader, being in drawdown is not something you're unfamiliar with. We know that trades may take a while to get into profit at times. But if you really truly believe in your trade and you don't let anything steer you off course, you hold that trade till stop loss. Oftentimes people get out just to cut losses earlier, and sometimes they're wrong and the trade actually goes their way. And as you can see, we acquired the 15 pips and price runs up and takes those as 15-minute swing highs. At times, especially on Thursdays, and I've noticed this before, Thursdays tend to run a little longer than 40 plus pips. Same thing as Tuesdays. The data has shown it in the Excel sheet as well. The Tuesdays and Thursdays tend to stand out the most out of all days for the model. Not to say other days don't provide 40 plus pips sometimes, but Tuesdays and Thursdays tend to be the primary drivers for this model and the workhorse for the model. And as we go into IPTA true day range, so 12 a.m. IPTA true day, going into the next day, we could see it trades even further than that. So if I were to play it out, and for transparency's sake, we're just going to move to the 5-minute time frame so it can move a little faster. And we play it forward, we could see it gives us 15 pips, and it goes even further than that. It continues to trend up throughout London, throughout New York. Now, at this point, you could have a trailing stop. This is all up to you. Remember that. Your trailing stop may be stopped because there's going to be points in time where market does like to sweep the low and then run higher. You can see it happens here. Price comes and sweeps these equal lows here at one point and then runs higher. You got to live with that. You can't always win those trailers or those moments in time where you want to squeeze a little more out of the market. The market will take you out eventually. Unless you don't move your stop loss from its original position, then you may be in luck. But trailing stops tend to often get knocked out because it's pretty easy to see where the stop losses are residing and where the market's going to find more sponsorship or find internal or external liquidity to produce trades or to move price. And you can see it trades higher. So it gives us more than 40 plus pips here. It continues to push higher and higher and higher. So this is just to show that this simple model right here, all we risked was 15 pips. But out of that, we got a much better ratio than a 1-to-1. So that's very significant, and I think it's something worthwhile to the trading community to point out that this model is very feasible, very approachable for any level of trading. So that's just one day. So if we move on to the next day, we'll see what the next day is. We'll probably just play it out so it gets over there. I wish TradingView had a thing where you could like fast forward a little faster to the point where you want it, but they don't have that, I believe. I don't think they do. Unless I'm just not the most technical person with TradingView. But the model itself is very straightforward, and it definitely can generate pips. It's a very straightforward model. You have to keep it simple. Remember, one trading model can change your life forever. So here we're going into the next successful trading model for the agent session. So we'll zoom in here. So this is the 16th of November. Play it out a little more. And we can see right here, agent session starts there. So this is another dead zone. See how the market's consolidating, especially towards the end, midway point of it. Price really starts to chop up around 6 and 5 o'clock in the afternoon, New York time, New York Eastern Standard Time. That's something I want to avoid. I don't want to be trading in consolidation. Now, you may be a scalper and say, hey, I can scalp down 10 pips, 2 pips, etc. It's possible. But for most people, the average trader, that is very stressful to trade in an environment like that. And why put yourself through that stress? So the same thing follows. We're going to find our swing highs and swing lows that are unbroken. So we have a swing high here. So we'll take that out over here. We have a swing low down here. I feel like I'm moving like a turtle because I'm not used to this computer at all. But luckily, if you're watching the recording, you can fast forward or speed this up and put it in ×2. Do whatever you like. And this is pretty much all the swing points that we have. I think these are relatively equal highs as well. So this swing high here. Is it recording? It's recording. Ooh, thank God it's recording. This swing high here, you can see it's relatively equal. So I'm not going to even mark that out. And then we also have potential of this being a swing point. We just got to see where the next candle closes. So if we play it forward, you can see we have a swing low here. So let's mark that off. And then we have the opening price of the session itself here. And notice this is a Thursday again. Successful day on a Thursday. The first example I showed you for the month was a Thursday. Every other day before that was unsuccessful or a failing trade. Now that's the open, the dash line. Don't get confused. That dash line is just the opening price, fair value. At this point, we play it forward to see what happens. Nothing, nothing, nothing. Now we have something cooking for us. We have a swing low broken. Price comes down and breaks that swing low. What does Deontay do? I run down to the 1 minute time frame, and now I'm looking for a market shift. Notice again where the market is selling. It's selling above in a premium. How did price get down to this 15-minute swing low? It went above the opening price for the session and then broke down. Like I said, I'm not looking for that setup, but it's just an ideology just to prove to you when you should be a buyer and when you should be a seller. When price is below the open, you should be looking to buy. Don't force the buy setup, but you should be thinking buy. It's cheaper. Don't think sell. When price is above the opening price, you should be looking for what? Sell. You're looking for a selling opportunity because it's much more expensive and worth your while as the seller. So you have two hats you got to put on. You're juggling two hats. Or you're a buyer or you're a seller. Or you're wearing no hats. You're sitting out in the market because you have no idea and the market's not giving exactly what you need. It's not following the steps or the parameters to your model. And you don't take the trade. Remember, no trading is no risk to your equity. That's always better than taking a trade and taking risk. Because anytime you click buy or sell, you are at risk of losing. Anything can happen. When everything aligns, the fundamentals, the technicals, the macros, all that stuff can align and the markets still can go against you. Now, many people may say, oh, that's not fair. That's what you sign up for. This is the trading life of trading. This is what you sign up for. Risk. It's all risk. We don't know if the trade idea is going to be probable or most successful, but we put filters and models behind it to put odds in our favor. Then we roll the dice and we see whether or not we come out to the battle a victor or a loser. So at this point, you can see 15-minute swing low is broken here. We're still waiting for what? The market shift. So we don't see any market shift. We don't take a trade unless we get a market shift. So play it forward, and there we go. We got the market shift right here. Just to bring it back so we're not lost. Zoom into that. I actually like the touchscreen a little bit. Just a little funky to get used to. We can see clear as day. That's the market shift here. Price runs through that swing high with speed. That's the entry technique that I'm using. Everybody asks me, hey, what's your entry technique? It's that. It's this every time. Now, there's other entry techniques that other people may be seeing, but I personally like to locate this one. It's one that eyes can easily see, and I think it's one that others can easily see to spot. Now, you may have your breakers, your mitigation blocks, or your propulsion blocks, or your volume imbalance, or your gaps, or things of that nature. But if you're going to keep it simple, stick to one or two entry techniques. If you try to look and hunt for all of them, you're going to get yourself confused, especially as a new developing trader. You want to keep it as simple as possible. Make it easy for yourself. Put things in your favor. Pick on your strengths. Leave your weaknesses alone. Same thing applies. You're going to go long now, and look at where we're looking for this long setup. Below the opening price of Asian session right here. This is the open here. Look at how it's below. So we're at a discount buying. Now, we're not at a discount according to like measuring a range high to low. Well, technically we are. So if you were to take this swing point up here and this swing point down here, we are still cheap. But for the session itself, we're in a discount, and I like that. That's where I should be buying. Now I'm going to look for a long setup at that fair value gap, right? So as soon as price hits that, we're going long. And we're going to go with a 1-to-1. So I'm risking $1 to gain $1. Now, I'm not going to draw this out for every single one, but I'm going to do it on this one. The next one, I'm not going to draw it because it could be time consuming. But I just want to be transparent with you guys here. It's close enough. Touchscreen, like I said, still trying to get used to this. And that's 15 pips here. So we got a 1-to-1 here, right? You're risking $1 to gain $1, which isn't too bad. As you can see, this 15 pip TP or target or exit does not reach that 15-minute swing high. But if you were to multiply this by 2, 30 pips up here, another 15 pips, we definitely would be able to achieve that. However, very minimalistically, a goal of mine is to achieve anywhere from 10 to 20 pips. Now, if you start getting to 30, 40 pips, that's very ideal. 40 pips, you're doing great. 10 to 15, you could take that. Other people may say, you only made 10 pips. You only made 15 pips. It's better than nothing, or it's better than inconsistent target taking. If you get 10 pips, you can move your stop loss to entry. And if price comes down and stops you, then you're still at break even. You're good. You didn't lose any equity. If then so, you could trail your stop loss into profit, or then some. We'll play it out, see what happens. See, we go through some drawdown. Price does trade back up, back to the opening price right there. Look at how sensitive the opening price is as well. Notice that. Look at how this price point of the Asian session is very sensitive. Look at how it hits it and then sells off of it. Then it rallies up into it again. Then it runs back below it. It's like it's threading the needle. It's threading the line in the sand back and forth. Now I'm expensive, now I'm discount. Now I'm expensive, now I'm discount. It's going back and forth until it finally breaks away, and the algorithm is ready and has booked all its orders to push towards the higher time frame trend or its short-term intermediate trend, because there's many cycles into the market. Now, but this model as well, just to add on, I'm not using it in conjunction to the higher time frame trend. I'm using it in conjunction with the short-term 15-minute swing highs and swing lows that I have available going into Asian session. And if you keep playing it, You can see here, stop loss is not hit. The TP is hit here. Now, many people may get afraid when price starts to draw down here and it runs up higher, but we can see how we're able to take out 15 pips out of the market without stressing ourselves about which direction the market is heading in. We're just looking for a purge and revert, and that's what we got there. It may not ultimately get up to that final 15-minute swing high here, but we were able to take something out of that. We just want to slice out of the pie, call it a done deal. Tomorrow's a new day. And if you're not trading the next day, like I said, the model could be very specific. You could only take these trades on, let's say, Monday only if you want to, Tuesday only, Thursday, or Wednesday. You can't do it on Friday because there's no agent session on Friday, nor Sunday. But for me, I would prefer and would recommend other people. Like I said, I'm not a financial advisor. Disclaimer, right? I don't want nobody come and say, "Oh, Deontay, I listened to you and I lost all my money." That's on you. That's a decision you and yourself had took on when you signed the agreement to trade with a live broker or a prop firm. That's all on you, not on Deontay. Remember, trading Forex is a risk that you and only you solely take. So do your due diligence on how you're trading. Consult in whoever your professional advisor is or someone who manages your accounts. And price runs up. Now, when we're looking at this as well, I want to show something as well here. Same thing happens again. So granted, this entry we had is much higher, but we can see another entry technique forms again. The same idea happens again. Look at how we have a swing high right there. Let me take it off the dash line so we can see it better. A swing high broken with speed. And this one's very obvious. It's a large candle here. A large candle going up. And where do we have a fair value gap? Going right through that. That's a sign that the market is going to most likely respect this zone, refill the inefficiency. Now, it doesn't have to refill it all the way. There are times where it does fill the entire inefficiency. As you can see here, let me draw it out. This entire inefficiency is filled and then some. It runs right past that. However, we have a basket of risks of something that we would like to take if price were to go against us. And you can see price does pull us in drawdown for that entry. This one, little to no drawdown. And you will have that. And it feels better to have little to no drawdown. It feels really great. And see how price respects that and goes higher. It's the same idea and the same concept. I'm still buying if I didn't see this entry here, which I would have if I was attentive. But let's say we weren't attentive and we missed it. And we're like, dang, we just missed a buy opportunity and we saw it drop. We're like, oh, thank God. We don't have to take that one because it would put us in more drawdown. But this one, it's a lower entry. It's not significantly lower than this entry point, but it is lower. Taking a lower entry is better for a buy setup, especially to you as a retail trader. Not sitting here and saying that you guys don't have the equity or the means to hold longer, but the average trader does not have the means to hold and draw down as large as the commercial speculators or the central bank traders or large fund traders. They can hold positions much longer, so they can endure drawdown and still be able to break even if price were to come back in the long term or even the short term. Some people can't stand that short-term drawdown because their accounts are too small. And maybe they are using poor risk management, which is on you, and they can't stand that 5 pip drop. I'm only risking 1 to 2% per trade, or even 0.5% per trade. That's a very big key when it comes to any trading model, the risk parameters. How much are you risking per trade? And we can see price trades up, and it gives us, and I logged it here in the Excel sheet, it gives us 20 pips. And after that, it doesn't hit 30 and it doesn't hit 40. So the max potential reward from entry between stop loss and TP, we only got 20 pips. And I'm rounding all these because it could have been 22, 24, 25 pips. I just kept it really whole number. And that was the max potential reward before price came back down to stop out the stop loss here. So I believe at some point in time, we're going to see price. Like I said, let's do it on the 5-minute just to speed it up. Price does come down and hit the stop loss. So before it hit the stop loss, potential max reward was 20 pips. So that's how I'm tracking this information here for you guys here. And I've noticed that this tends to be a very comfortable zone. Not saying it's the most optimized stop loss and optimized TP, but it tends to be a good one to take something out. And for me to be comfortable taking that risk of 15 pips with a 1% trade on my equity. So we're going to 15-minute time frame, and we look for the next trading day. And you notice the setup is all the same. Nothing has changed thus far. I've been keeping this model the same over and over and over again. The only thing that has changed from the beginning of it, I was taking the very first fair value gap that formed without any market shift for the long or short. I believe that it is still possible to find those entries, but I think it's better to wait for the confirmation with the market shift. So here we're coming into another day. You can see we're coming into Tuesday. Let's zoom into this one. I'm only talking about the successful Asian models that we had this month. Once again, the same thing applies. So we're going to find what 15-minute swing highs and swing lows to help us gauge a potential opportunity for this session here. So we find the lowest low or swing low. So we have the lowest low here. It's not a swing low. Notice it's not a swing low here. It's not a swing low, but there is a swing low here. I'm not going to mark it off just for time's sake, but it's relatively equal lows here. We also have another swing low here. We have one here. We have another one right below it. So these are all relatively equal sell side liquidity areas. Sell stops below here. Breakout retail traders are trying to go short. If it breaks those lows, they're going short. That doesn't mean they're always going to be wrong for going short, because there are times where they are correct. You have a 15-minute swing high as well. So notice that swing high is also a swing low. So you can have that within the same candle. That's a swing high, and an upside down is also a swing low as well. We have a swing high here. Let's mark it off. We have another one up here. Really small to see. That's one there. And then we have the highest high as well, which is also a swing high right there. So we have all our potential areas where the market can purge and reach for and draw for during the Asian session. Now it may not do it exactly during the Asian session. It may do it after the Asian session as well. So going to IPTA True Day, it can also do that as well. So if price is going to be trading in one direction, it can normally run up and be sensitive to that price point. And Pops was just checking on me. He just walked in and knocked on the door. He's like, sorry. You have the opening price here. So if price is gonna go in either direction, you want to wait to see what it's going to do. So if we trade it forward, we can see it breaks both sides, but we want to see exactly which side did it break first. So when we go in a lower time frame, we're able to see the storyline behind that. We can see that price first breaks this swing low. It breaks multiple swing lows, in fact, right? Breaks that one, breaks this one, and breaks this one. All of these here. All relatively equal lows. On the 1 minute, you can really see how they are equal lows here. We can't really see that on the 15-minute time frame. It only just looks like steps going higher on the 15-minute swing time frame. Price, as you can see as well, for this rally up, what did it do first? It dropped cheap and then rallied up. Do we see any market shift here? No, we do not. We do see a fair value gap. It does trade into a small inefficiency here, and it runs higher, but that's not what I'm looking for. No market shift occurring here. That fair value gap here that we see here, there's no fair value gap running through it. None at all. So we're not even going to look at that. Now we do have price running up and taking out this 15-minute swing high. So we still have on the table a selling opportunity, because price is now where? Above Asian Open. So what hat are you wearing? The seller's hat, not the buyer's hat. You don't buy in a premium. Just unrealistic. Not to say price can't continue to trade higher while it's in a premium, but you should not look for that setup, especially at the beginning stages or the first 2 hours of the session. So we're trading, we're waiting, and we're looking for a market shift. And we got one right here. You can see price even traded right back into it right there. So if you zoom in, if it's unclear for some folks, this is our swing low, 1, 2, 3. By definition, this is a swing low, 1, 2, 3. Let's draw it out. There you go. Look at how price trades right through that swing point with this speed down. And look at how price trades back into it there. That's the market shift mixed in with the fair value gap. That's what I'm looking for. While breaking a 15-minute swing high and being above the Asian session opening price. Wow. Now you start to realize when you should be a buyer, when you should be a seller. You keep things very simple and concise. You keep these rules, you're most likely going to be in the right side more times than not. What do you do here? You go short with a 15 pip SL or 20 pip SL and a 20 or 15 pip SL as well for a 1-to-1. If not, you may want to go for 2-to-1, a 3-to-1. That's all up to you. But personally, it's very achievable to be successful with a 1-to-1. You're just playing the tortoise game instead of being the hare or the rabbit, being the fastest to get to the finish line. That may not be the best for you trading wise. Now, there are successful traders that do that, much more riskier, but with high risk and high reward, you can really burn yourself out. So take your time. I personally take the approach of the tortoise. Take your time. Long-term wealth is built with patience. You don't want to rush the profits. Let them come to you. You don't have to be rich overnight. Take your time. So we're going to see. I'm not going to put the trading parameters here, but the stop loss and TP. But we're just going to play it out to see what happens here. So we play it out. And as we can see, look at our price slowly breaks itself down, gets to those 15-minute swing lows, right? Now, even though this 15-minute swing low here has already been broken, it's still recognized by the algorithm. It's still a significant swing low. These swing points are significant. That is something I've noticed trading the Asian session, that price is still paying attention, or just trading in general. Price still pays attention to old lows and old highs that have already been hit already. It's significant because it's a swing point. That's why you're seeing price react around it here. Price traded right down into it and then give a move back up. Also notice, before it got down into a discount, notice how price traded into the discount and then back up into premium, back down into discount again. Isn't that interesting to see? Price trading up into premium and then dropping down really fast. And these moments in time, what are they doing? Inducing traders to the wrong side. They're probably thinking or being very optimistic that price is going to run up here and then go higher. They get retail traders to get back in and be confident in longs again, but that may not be the case where market is going to go. I tend to like to stick to one side of the market. I don't like to take the twin trade, the buy and sell. I've have moments in times where you can find a buy setup and a sell setup with the model. The same thing forms on the sell side and the buy side. So you get a market shift to sell, and then eventually you get a market shift to buy as well. But I like to just take one side because it keeps it simple for me. When I start to do too much, you start to see risk, you start to overthink, you start to abandon your strategy, you start to abandon the rules. That's not what we're doing. We don't want to deter from the model. If we already have a working model, why get off the workhorse? Let the horse work. Let it do its job. Then when it's time, we leave it alone. And then we get back to work when it's time to work again. That's how we do it. And play it out forward. Now, I'm not sure how far or how much profit we got that day. Let's double check. So this is Tuesday, the 21st. So if you look at the Excel sheet, we can see we only got 10 pips potentially. Right, max potential. So that could have been anywhere from 15, maybe even 16. We definitely didn't hit the 20 pip threshold here. It was a fail. But we did get 10 pips very minimally, right? Not to say you would have scaled out at 10 pips, but this is just to record data to show how far from the entry you got into profit. And it was 10 pips just that day. And now, oops, if we go down, the next day that was profitable was this Monday. And it really stands out here. This is the last successful one for the month. And this Monday happened to reach 70 pips. So you see at the end, you have the P, which this column here is 40, but you can see there's 3 plus signs. So that's 10, 20, 30. So 40 plus 30. You got 70 there. So let's look at that example there. Model is very straightforward. You don't have to trade every single day to be successful. I've never heard anybody saying that they have to trade Monday, Tuesday, Wednesday, Thursday, Friday, and even Sunday, that half day kind of thing, to be successful. I've never heard anybody say that they have to trade every single day to make money in trading Forex. Because there are times where you take a trade one day and you're able to hold it for multiple days at a time. And there is examples I've shown that the Asian session is a turning point for a trend or a new leg in the market. It is also a kill zone, the same way New York. Is this a Monday? Yeah, this is a Monday. And this is, I think, a Tuesday. Just want to double check because I see two things marked here. Because I could have another day that was successful. Oh yeah, so 20 pips. So we have one more after this 70 pip run day. Just gonna delete that and delete this. I'm gonna play it forward. Perfect. So you can see this New York lunch session, at one point in time, it did consolidate for a while here. Right? Not an environment I want to trade in. And then it continued to break down. But overall, it was really trendy. Like I said, it's not always going to give you consolidation, but it's most likely going to. And the fact that it's going to just tells me leave it alone. It's an easy way to keep myself out of the market. Any successful trader is going to tell you, you need to have moments in time when you're not trading. Whether that is intraday, a certain amount of hours you're not trading, or whether that is monthly, certain months you completely don't trade. Or there are certain weeks of the month you don't trade. So the first week, NFP week, right? You don't really want to trade that week. Most people will get in and trade it. But for the unexperienced or inexperienced trader, I would recommend you to avoid the first trading week or the week NFP lands on. Just leave that whole week alone. Demo trade that week. Demo trade NFP. The next week, get into trading for the rest of the month. So what do we do here? We're going to find our swing highs and swing lows. So we got a swing high here. Really do hope the audio is fine. Hold another laptop, so things may sound a little different in this video. So do bear with me. Like I said, I do appreciate all the support and love that you guys give me, all the questions. I really do appreciate it. I really do love teaching people this stuff. And if I can do it, you can do it as well. If I win, you can win as well. And we're going to see if this is a potential swing low. And we can see it is. So this is a swing low. So we just mark this off. Notice the swing point is still landing within the New York lunch session. It's landing in the New York lunch session. That's what's happening. This still counts. Even though this is 8 p.m. and it's a part of this Asian session, it's still a part of the New York lunch session because the New York lunch session ends at 8 p.m. So we're going to count this candle here. And this candle just made the cutoff. And it's the actual swing point. So that's why we're marking it off. I'm going to mark off the opening price of the session. So it's a down candle. So the open is here. Here, here, here. And boom. We got the open. We have our targets. We have exits. Depending on which way the market gets. We're not trying to predict. As soon as the Asian session opens, we're not going to jump in, buy, and sell. We need to do something, then do another thing, and then react. So there's two steps to it. It needs to break something. It needs to show a market shift, and then we attack. Play it forward. I'm going to see what happens. Price does what? Purge. There we go. We got the purge. So now, the fact that we purge sell side, we should be looking for a revert back to buy side liquidity. It even made a short term 15-minute swing high here during the Asian session. So that's also in target. But we do have the original targets that we have listed off in the late New York PM sessions here. So all of this here. Now this model I was taught by ICT, but in a different version. So if you go on this channel, right, Inner Circle Trader, there's a video called 20 pips per day. And he shows how you could utilize the yen crosses during the Asian session. And he showed by price breaking a short-term low or short-term high, you just go in short or long with a, I believe it was like a 20 or it was like a 40 pip SL and a 40 pip TP, a 1-to-1. But he didn't break it down to the level that I'm showing it. Not to say he is incorrect. He's not favoring that one, but he was just being transparent and giving you guys full capacity of what kill zones to trade, because this is still a viable kill zone to trade, but it's preferred to use yen crosses. And if you watch that video, you'll see how I derived to this model that I'm showing to the trading community today. It's very simple. I like my model because I modified it. I put more specific targets and exits, and I put a different TP on it and stop loss on it. It's pretty similar to his because he did 40 to 40, but I don't think you need to risk 40 pips as an SL here. I think you could risk less. If it's going to run you 40 pips, I don't think that's necessary. I think you could cut that in half. We could do like, let's say even 25, you know, if anything, or even 15. Go down to the 1 minute. What are we looking for? The market shift. That's the dotted line. So this dotted line is Asian Open. We're below it. What should we be? A buyer. Why should we be a buyer? Because we purged sell side, and now the market should most likely be expected to run back to buy side liquidity, or at least back to Asian Open fair value. It should at least give us a run back here. We don't have to run for the 15, 20 pips higher. We can at least get a draw back to the open. You know, this can tend to be a magnet to the price action. Play it forward, and there we go. We got that market shift. So we zoom in. Now for a new trader, you will have to train your eyes to see this. But the market shift is right here. For those that are a little more experienced or have been trading for a while, you're probably seeing this much faster than me. Or I even sound like a broken record to you. All you do is show the Asian session model. Yeah, I show it because it's not broken. Why fix it if it's not broken? Now you may find a way to optimize this and find a way to use this better than me. But as of right now, this is the way I like to use it. There we go. That's where we would go long. We would set up our parameters: 15 pip SL, 15 pip TP, 1-to-1, 20 pip TP, 20 pip SL, 30 pip TP, 30 pip SL, 40 pip TP, 40 pip SL. That's what ICT was recommending, the 40 to 40. And now price broke it. Price trades down into it. So we're long now. You can also notice, see how price completely takes over the whole fair value gap. There's people that would argue in the trading community that saying if the fair value gap is completely disregarded and disrespected, it turns into a fair value gap of a false fair value gap, and it turns into what that support and resistance idea in the retail community. So if it breaks and fails the fair value gap and price trades back up into the fair value gap, you should go for shorts. That's possible. That does happen. I do not disagree with that. However, I'm going to stick with the stance of what my model is telling me. I'm not going to abandon ship. I'm going to be true to the model because I've done it a couple times already, a couple months now, to see that there are times when the market does pull you into drawdown and still goes higher. That's just an area where I want to get the entry. It could pull a little lower, and there could be a lower point where price wants to pull it before turning around. I don't know where that point is, but I do know that I can see this. This is something that I can strategically see and put data around. Press play. You can see how price, look how it's trading right underneath fair value. And even when it created the fair value gap too, look at how it hit fair value perfectly. It's a very sensitive price point, and then it ran off of it. And let's zoom out, because this is the one where we get a nice run up. And we get 70 plus pips. And this is as far as we get for the Asian session. Like I said, there are times where the Asian session tends to follow the higher time frame trend. It could be the pivot point, it could be the turning point for price to go higher in a new leg on the higher time frame, daily, weekly, monthly. And into if the true day, going to the next day, if you're still holding that trade and you didn't move your stop loss, or you had a trailing stop loss that didn't get hit, like I said, most trailing stops do get hit, because it's going to aim for equal lows. So it's going to target swing lows, because below swing lows is sell side liquidity. And you can see how price trades all the way back up there. And where does it hit? Look at how it hits perfectly. Swing high, swing high. And let's also quickly examine when it hits these swing highs. So notice, hits that swing high. Look how market gives clean highs too, clean close, a clean a clean open for the down candle. Touch, gives a tail right into it, and then sells off. Then it runs sell side real quick. Right, runs some type of swing low. Runs right through a swing low. Can't even get it drawn perfectly. And then it runs higher. That upsets some people, which happens. Hey, it happens, especially if you had a trailing stop below that low. You can see how easy it is to target people, right? It's almost like they know where your stop loss is, because we all have been taught to put our stop loss below the lows. It's the most ideal area to put it to protect yourself. And price runs up. Notice as well how price blasts up and through that 15-minute swing high that we marked off back in the New York PM session, late PM session, the lunch period. Runs straight up here. Fast, a large candle. And also within this leg here up, we can see this ideology that I refer to, taught by Larry Williams, the natural range change of the market. Large range, small range. We can see at the very bottom of that range here, we have a small down candle and then a large up candle. And then right after that, we get another small down candle, another large up candle. And the pattern repeats over and over again. You'll also notice this on the higher time frames as well. It's very much more obvious on the higher time frame. I've shown this multiple times just to bring it to light to the community, to make higher time frame and swing trading easier for those folks that don't have time to trade. I think it's very useful and something you should keep in the arsenal to think about when trading on a higher time frame. But remember this little thing that I circled here. You're going to see it again on the daily time frame on all pairs, all asset classes, large range, small range, and counter trend candle. So the market is trending up. Notice how after every down candle, at least in this example here, this price light going up, after every down candle, there's buying occurring. Buying is occurring after every down candle in this up bullish trend here. So keep that in mind, because we're going to talk about that here with gold on the higher time frame or even other pairs. But you're going to notice that same pattern here again. And price takes off and trades higher. And I think we have one more level during that set. Oh, we have two more levels in that session. And price completely melts off of that. And then I think it comes back up to the top of that again. If I'm not mistaken, I could be incorrect. Yeah, I was incorrect. So then you can see here, price continues to break down, and that would be the final TP, or the max potential profit from that long on that 1 minute fair value gap. All it took was 15 pips of risk to gain 70. I like those odds. I really do like those odds. And it's strategic, and it's really straightforward. Like I said, anybody of any trading experience can use this model as well. And this is the last one of the month we have here. So we're going to do this real briefly. We got this 15-minute swing high. Notice every single example I showed you was the same. There's no fluff into this. There's no gray area. And if there is any gray area, please text me. Leave a comment underneath this video. Please watch the Asian Session Series library. And at least in my experience and in my belief, I think I do a good job explaining it. Not to puff my chest up or toot my horn, but I think I do a really good job in explaining this very simplistic model. Sound like a broken record. I know. I apologize for sounding like that. You're not posting new content. The content's the same. Of course it's the same, because I'm showing you what I do. And what I do is the same. It shouldn't change. It shouldn't change. There are a lot of models out there that I've tried, that I am unfamiliar with, that I do not like. I don't have to use those models. I don't have to show you a new model. I can show you exactly what works for me. So you have the lowest low of the Asian session. You have some swing highs marked off, equal highs. We even have one here. I'm not going to mark it off though. And we can see price trades down. Let's see. Playing it. Price trades up. We got to a 15-minute swing high. So you see, we don't break that 15-minute swing low. So don't be quick to just say, oh, it's going to break that low, I should get ready to buy. When you start jumping into the market like that, you tend to get caught off guard. Look at how they catch everybody off guard that potentially thought that this was going to break down and go short. It didn't though. It quickly turned around. The market can do anything like that on a dime, on a split second. Even if there's no news involved, it could do that in a split second, even during the Asian session. And we know the Asian session primarily is consolidation. The characteristics of the Asian session is consolidation. But we know that we could potentially grab anywhere from 20 to 30 pips out of it in that consolidation. And at times, we can get the Asian session to trend even further, especially if we're using pairs that are paired to move, sorry, not paired, but primed to move during that time period, during that session. UJ, EJ, AJ, GJ, CJ, and there's another CJ. There's Swiss J, which is CHF, JPY, and then there's CAD J as well. All those yen crosses as well are most likely going to be much more volatile during this time period. So please pick pairs that are prime. That's not to say EU or other majors like GU, NU, UCAD, Swissy cannot follow along with this model as well. It's just not preferred. I've shown examples of where other pairs outside of the yen crosses do work with this model, but I just don't recommend it. And in the series as well, I'm only showing UJ as well, just to show that you can trade UJ. And I know UJ is a very popular trading pair in the FX community because it's very volatile and you get most bang for your buck. You get a lot of pips. It moves. It's very quick. It's exciting. However, it can be very dangerous at the same time if you don't know what you're doing. Price trades up, hits a 15-minute swing high. So just to show here, we have price coming up at 147.999, and then we got a stop loss of 147.35. And then we were able to get 10, 20 pips. It doesn't get us to 30, and it doesn't get us to 40. So we only got 20 pips for that day. So let's see what happens. Go down to the 1 minute time frame. We're above what? The Asian session high. Push play. And that's pretty too fast. Slow it down. Zoom in. There we go. This touchscreen is going to be the death of me. All right, we got that one down easier. So what do you have here? There you go. That's that market shift right there. You had to be patient for it, though. You have to be very patient for it. That is the market shift after breaking this 15-minute swing high. So see, price comes up, breaks it right here, and then we start waiting. We wait. Any market shift? Any market shift? No, 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 no. Yes, a fair value gap here, right? The old way I used to do it, this would have been the entry here. This would have been the entry. It would have been a better entry because it's higher. But however, I don't favor that anymore. If you want to continue going with that, taking the first fair value gap after the 15-minute time frame swing point has been broken, you can take that. Me personally, I don't recommend it anymore. I think waiting for the market shift first is more preferred. Then I would look to go short inside of that. Play it out to see what happens. And we can see we have a feasible trade idea before price probably returns back up to that area and ultimately would have stopped you out. Yep. And price continues to rally up higher. And that would have been, you would have been stopped out by then. But you could see how price did decline down. And that decline down would have got you at least 20 pips in change. Like I said, I'm rounding the numbers. I didn't put like 26.7 on the Excel sheet. I just wanted to keep it simple. I didn't want to put like too many things on the chart. Keep it very simple on the Excel sheet, numbers wise. And that's the Asian session model, folks. Now, that was the very first topic of the live that I talked about. The next topic we're going to get into is December seasonality. We're also going to blend this with gold. And we're going to blend this with the other topics because all these other topics do come together. Everything that I'm showing coexists together. When you do separate them, it's very good to see it. But when you put it together, you start to see how trading is very multi-dimensional. It's not one-dimensional. Everything has to coexist together for you to come to a narrative or to see the market flow in a certain direction. So now we're just going to look over to gold. So we're going to go into our next one over here. I believe it was this one. Yep. And we're going to look at where we had it. It was gold versus the US dollar. Now, just to talk about gold and give a quick breakdown and thought process on what gold is currently doing. Let's clear this chart. Gold is real money. You heard me. Now, why would anybody call it fake money? Of course, it is real money. You can see it's trading higher. And I believe we're pretty close to breaking all-time highs. When I did the recording, I said, wow, we're really close to breaking all-time highs. But gold has been standing a test of time. And what a large candle. It's Sunday already. It just shot right up. It's not Monday. It's still Sunday. Today's Sunday night that I'm recording this. Oh, man, what a large candle. Gold is just incredible. And if we see gold going up, we should be seeing what? Dollar going down. That's your correlation there. Inverse correlation. Now, gold over the period of time, going the largest time frame chart that we have available on TradingView, has been a great investment for those that have been buyers. So anybody that's buying and holding, they have been successful in getting some profits buying gold. Gold is now over 2K an ounce. That's impressive. Oh, I think gold just broke record highs. Look at that, folks. Haha. Yo, this is really sweet. We're living through history right now. We're living through history, and I'm glad to be a part of it. Gold breaking record highs. I have to text that in the chat right now real quick, because that is something that is really impressive. Gold all-time highs. Wow, man. That's impressive. Gold hit all-time highs. Whoo! Sweet. So, gold has been a asset class that has been valued much more than fiat currency. So, paper fiat currency. So, the current monetary policy that we have, everybody's walking around with paper notes in their pocket. You know, whatever country you live in. I live in the United States, so the main fiat currency or note that I walk around with in my wallet is US dollars. Now, US dollars have been on a decline since way before I was born, since Nixon took it off the gold standard, since a lot of things has happened with it throughout the history of time. It has always been depreciating. Now, gold has been standing the test of time, a test of inflation, a test against coronavirus, a test of a lot of things, you know, COVID, lockdowns, everything that you could imagine has been thrown at gold, recessions. It has always been a hedge against inflation, against recessions, and it's been bringing people a great ROI. You can even arguably say it's bringing back a better ROI over Bitcoin. And even though I know Bitcoin is still young and youthful, gold has been the prime breadwinner when it comes to a bullish trend. Now, the same could be said against any other currency. So this is gold versus Australian dollar. And this is gold versus euro dollar. Now, if you were to look at any other pairs as well, gold versus CAD, gold versus Swissy, gold versus New Zealand dollar, you're going to see similarly the same things. Now, I know there might be one currency pair that is outpacing gold right now. I don't know which one it is right now, but generally most fiat currencies around the world are not outpacing outpacing real money gold. I even have it marked off in my watch list as real money, as a little joke to myself. You got to be really, organized. I have bonds, I have the futures, I have the yen crosses, I have the majors, and I have a few things that I was trading. I just got into trading US 100 and NAS 100 because I thought I know how to read the stock market and dollar, so I should be able to trade that as well because they're correlated and inversely correlated. And you got stocks as well. If gold's going up, stocks is going up for sure too because dollar's going down. That's just the direct correlation. Now, going back to gold versus US dollar, on the monthly time frame, seasonally, right? Now, you could use different websites to acquire the seasonal data. Now, I use chartequityclocks.com, and it's something I share with you guys. I'm not promoting them. I'm not paid. It's not a paid promotion. I just use them to find my seasonal tendencies on there. But if you could not use that, or a very simple approach to finding a seasonal tendency for the month, look at the previous month, right? So we're currently in December, and you can see, oh man, that thing is very bullish. Thing is not stopping. Everybody's probably betting against it from selling. And it may sell off at some point. Not to say I don't know when, but it will eventually sell off because it's really high. But if we go back throughout the years and check the previous year's December, let's see if it was bullish or bearish. This is 2022 December. It was bullish. Let's go back another year from there. Do we see another bullish December? We do. Another bullish December. Let's go back another year. Let's see if we get another bullish December. We do. Another bullish December for gold. Now, many people may say, but we're during the point of COVID and lockdown, so it was probably expected. You know, people were panicking. There was a lot of fear in the world, so it's going to most likely rally. Okay, true say. Let's go back even further. So let's go back into 2019. Bullish. Before the COVID talk, right? Before it started really becoming very known that there was a deadly virus spreading around the world, right? Let's go back another year, December 2018. Another bullish month for gold. Very interesting. Eventually, there's going to be a bearish month for gold. See, 2016 was bearish. And then we got, let's go back to 2017. 2017, bullish. Overall, can we not see the seasonal tendency showing itself here? Bullish December. Gold tends to be bullish in December. Now, if we know that gold is bullish in December, that would mean most likely dollar is bearish in December. So now we're talking about correlations here. So now you're able to start to understand certain things. So we should be seeing dollar dropping if gold is rallying. So let's see. Right now, currently, the candle right now is dropping for December for DXY. Let's track all the Decembers in the last 5 years. That's January. Move it over one. Bearish. 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 Like I said, maybe people may say, it's COVID though. People are probably panicking and not buying dollar. They're buying stocks and other things to protect themselves. Inflation was running high, so they're getting into other asset classes besides fiat currency, paper money, paper notes, to get in. 2019, still bearish, before all the COVID talk. Let's go to 2018. Bearish. Let's go to 2017. Where are you at? 2017, December. Bearish. And then we had that 1 month in that correlation, that 2016 one, that was bullish for gold. And if it's bullish for gold, that would mean what? I mean, bearish. It was bearish. Correction. It was bearish in was it 2016 one? Yeah, it was 2016 one. Sorry, I was putting it on the 20. I don't know why I put it on the 2015 one. There you go. There you go. You got your bullish. Come on, D. It's touchscreen. All right, mouse pad, we go. So gold was bearish for 2016. You can see here clearly dollar was bullish. But historically speaking, we see that dollar tends to be bearish overall. We had a bullish one there. So if it was bullish in 2014, that means gold was bearish in 2014. And then we go 2015 is bearish. So a lot of signs showing you that seasonally over time, DXY is bearish for December. So you already kind of got insight going into month. We got insight knowing that DXY generally is bearish. Now that may not be based off of what the current trend is, higher time frame, but that may be based on just seasonality and macros and what's going on in current geopolitical terms. And during that quarter, right, Q4, the last quarter of the year, We normally have a Santa Claus rally in stocks. Stocks tend to rally. Stocks is inverse to DXY. So stocks rally, dollar drops. So if stocks tend to rally in November, that means the inverse should be happening for DXY. And the direct correlated should be happening to gold. Stocks and gold move up together. Dollar goes down. Now, once you start to figure out these things, you start to build a roadmap for yourself. You could do this for any month. I'm only talking about December because we're in December currently, presently. You could be doing this for any other month as well. Go back and see what the last 20 years has been for that current month. If we're in January, go back the last 20 years and see what January occasionally gave you. Was it a bullish or bearish month? Or is it pretty indecisive? Or is it really predictive? You know, is it always normally giving us a bullish month? Or is it normally always giving us a bearish month? Or is that month pretty small range? And speaking about ranges, let's go to gold real quick. Gold has been showing a lot of the large range, small range tendencies, and I've been using it as an example, not to say other pairs haven't been, but let's just check out the last month we had recently. So let's check out November. So this is the start of November going into December. And we could see that same idea that I showed you, I circled off on the lower time frame, and then one of the examples for the Asian session model for UJ, we can see it's happening here as well. Look at how the market goes into a small range candle and it's down, and then the next day it goes large, then it goes small again, then it goes large, then it goes small, 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 and then large again. Small, small, and counter because it's down against the trend, and then large. And then potentially you could have a trending model. It continues to shoot higher, higher, and higher, and higher. That could be a cycle as well. But generally, the rule of thumb is if you get a large range day, do not look to expect the next day to be large as well. Because what does large candles do? It psychologically entices traders to go long. It's a very natural thing that we traders do as human beings. It's like almost a dog seeing its favorite toy and salivating and chasing after the toy when you throw it. They throw the large candle out. All the retail traders come in chasing after the large candle. In FOMO, fear of missing out. They want to make sure they catch that move. But by the time they've already seen the candle move, and they open up the MT4s, they open up their charts in their trading view or whatever platform they're using, the move has already left them. The boat has taken off already. You've missed the party. And everybody's trying to chase the party, but the party is going to die down. The excitement's going to go away. Everything that was cool and lit is now gone. And then it feels like the market's against them because they go in long the next day, or they go in long at the high of the day, and they see the volume increase, and they see the volatility, volatility. They see the volume and how volatile the market is moving. Excuse me. And they try to chase that. It doesn't work always that way. Sometimes it does favor you. Sometimes you get back-to-back large days, 2-3 days very large, but it's unlikely for that to happen. And if it's unlikely, don't do it. You want favors in your odds. It is likely that after a small day, you get a large candle. The small days, psychologically, bring no interest to the market. People are not using FOMO. People are not in that mindset of fear, missing the move, because they're like, oh, it's small. It's not going anywhere, so I shouldn't have to trade it. But when it's small, that's when I and you should be attacking. You should be going into the next day attacking. The daily time frame is my favorite time frame to use for this idea. The same thing can happen on the weekly. The same thing can happen on the monthly. Now, if you're just looking at this month, you'll notice after all down candles, let's just mark it off briefly. After all these down candles, let's get it going. Down. Now, hindsight, I know many people are going to criticize and say, that's hindsight. You didn't know what's going to do that. I didn't. But I've seen this happen other times in other months. And it's easy to predict. Not to say you're going to get it right, but the probabilities is my favorite because the hindsight data has shown me patterns that I should be looking out for in the future. Because these same patterns that I'm showing happened in other months I showed you as well this year. If you go back through my daily tracking videos, now I know I kind of fell off with them because I've been trying to be consistent with the new farm business that we got going on here in New York. You'll see that those months also show the same signs that I'm showing you here in November, the second to last month of the year. It's the same idea that I'm showing you here right now with the counter trend candles happen in other months as well. Since this is an uptrend, down days is basically price going on clearance or being at discount, in the trend at least, and price trends higher. I do have a video that talks about the characteristics to a bullish and bearish month, which I do think it helps traders understand how these months progress. You get a better idea of what the month is most likely going to do. So if you're already going in with the insight of the month being bullish or bearish, you can use techniques like this to get into the market and capitalize on opportunities like that. If you came to the conclusion that November was going to be bullish, buying after every down day in that month would have been successful for you. Am I right or am I wrong? I'm right. It's clear because the data shows it. And it shows it on any other asset class as well. Same thing can be said vice versa. If you are in a bearish model and you are looking to find a selling opportunity, you want to sell after up days. This is just a quick overview because I know we're going to be talking about gold, but just look at all the up days for this month for DXY. If you happen to sell, and there are some brokers and prop firms that do allow you to trade DXY. I don't want people to get confused about that. You can trade the DXY. Not all brokers do allow it though, but there are a handful of them that do. If you would have sold after every update in this month, you would have been profitable. You would have at least come out with some type of progress. Not to say you would have been super profitable or you would have been profitable at all, but you would have seen, better way to say it, you would have found success in selling after up days. However, you would have to figure out the trend. That's the thing. And I already have a whole video on telling you guys how to find the trend. And I will be dropping a 3-part series on finding the higher time frame trend via daily time frame. And it's a very simple approach. I'll show you techniques, entries, ways to read the market, things to anticipate, how to recognize bullish and bearish trends. It's a simple formula. And I'll post that later this month as a gift to you guys. And the same thing can be said inverse. You want to sell after up candles in a downtrend. It's just most likely preferred. You can even see this large trend up here for dollar. Dollar just hulked all the way up. Let's just circle it so we could all see that. That uptrend, imagine just buying after every down day. You're telling me that's not profitable? It's a very simplistic approach. I say that word a lot. Simplistic. Deontay, you say that so often. Because it's very simple. I'm a simple trader. I'm not like most traders. I'm very concise. As you get older and you get more experience, you're going to know what you like and don't like. And that's the same with anything in life. As you get older, you know what food you like. You know what friends you like to hang around. You know what places you like to hang at. You know what spots you like to go. You know what colors, what clothing, etc., etc., etc. You know what you like and what you don't like. And the sooner you know that, the better. You know? And that's something that we all have to go through trials and tribulations with as we age as young men and young women. We are going to eventually figure out what we like and don't like. And I figured out 5 years into my trading career what I like and don't like. I had to obviously study the market, backtest things, study ICT's material, and not binge it. You know, go and find real life examples in the market. Not just see him show me a model and then every single day I'm going to go live and trade it. No. Demo trade 6 months to a year. Or even more until you feel comfortable to risk your own money. No one's going to tell you to go risk money. If you lost thousands of dollars, that's on you. Unfortunately, within this trading journey or this trading community or industry, let me say industry, this trading industry, it is very sad to see how a lot of people are manipulated and misconstrued the idea of what trading is. Trading isn't as easy as it seems, but with the right guidance and the right mentor or the right lessons in the right course, you can learn something that can actually bring you a substantial amount of profit. Now, disclaimer, I'm not guaranteeing you profit off of these ideas or models. Don't want nobody coming after me, but You can find means to find successful models that could potentially, in return, grant you some type of supplemental income from your side hustle or your full-time job or business or part-time job. Or you can potentially use this to make your full-time money, and this is your primary source of income. It's very difficult to break that threshold, however, because many people don't get there because they're not consistent enough. However, I'm trying to show you consistency with certain ideas and certain models. I'm not wishy-washy with the things I'm telling you. What I tell you is what I do, and what I do is what I tell you. There's no difference to it. Hopefully that makes sense. But in this uptrend, every down day, buy after it. See how profitable that could be in an uptrend, especially if you're in a super bullish trend, right? You're in a mega trade, or it's a mega trend, up or down. If you use that ideology that I'm telling you, you can find very successful results. And you're gonna find some days where, the pips are coming in, and other people just can't imagine, how did you catch that move? And when you explain it to them how simple you found it, they're like, oh, I don't believe you. You're a retail trader. You're using indicators. You must be cheating. Oh, that's fake. But let them think it's fake. There's no reason to go out there and boast and show people what you're doing. Keep it to yourself and move forward. Doesn't matter. Don't listen to people in the chats and all the other channels that you're in, the Discord and Telegram this and Twitter this. Everybody's going to want to feel good and puff their chest up and say, yes, I caught 200 pips. Yes, I caught 300 pips. How much pips did you get? Oh, you only caught 15 pips during Asian session? You suck. I don't suck. And nor do you. You guys are intelligent people. Everybody that's watching, everybody that is supporting, everybody that's texting me, everybody that's in the Telegram channel, who subscribes on YouTube, who follows you on TradingView, who follows you on Twitter, even though I'm not super active on all social media platforms, because, hey, a brother's got to make money, a brother's got a family, a brother's got a girlfriend. I ain't got no time to be Twitter typing against people, right? You only got one life, and I got to make it count. And there are bigger things outside of trading that matter. Money don't matter. However, unfortunately, I had a conversation with my best friend today, and it happens that money tends to be the vehicle or the variable to get to happiness. Unfortunately, in the world that we live in 2023, going into 2024. Who would have thought this whole year would have flew by so quick? And now here we are, coming toward the end. I wish you guys the best. Hopefully you guys were very successful in your year of trading 2023. We are going to be heading into 2024. Some interesting times for us, man. Very interesting times for the world. And I pray for everybody's safety, no matter where you are in the world. I really do wish you guys the best. Hopefully this was insightful. Peace.